Welcome to the Deep Dive. Today we're taking a close look at a brand new ETF. It's called the Vista Shares Target 15 Year Berkshire Select Income ETF, ticker OMAH.
OMAH, yeah, got our attention too.
Exactly. So our mission today is pretty straightforward. Give you the essential knowledge, what is this fund, how does it actually work, and maybe help you figure out if it's something you should look into further.
And to really get under the hood of OMA, we've gathered quite a bit of info. We've got the official fact sheet from Vista Shares, website stuff, several articles, even a YouTube review. So a mix of perspectives.
Right. We want to cut through the usual financial jargon, make it clear, hopefully engaging, and just explain the core mechanics, the potential. So by the end, you'll have a solid base to decide, okay, is this worth more of my time?
Sounds like a plan.
Okay, let's dive in then. At its heart, what is OMA?
Okay, so OMA is an actively managed ETF, exchange-traded fund. It just launched March 5th, 2025.
Pretty new then.
Very new. And it's got two main goals. First, high monthly income. That's the big one. Second, long-term capital appreciation, kind of a secondary objective.
Okay, high income first, growth second. How does it try to achieve those? What's the strategy?
Well, it's sort of a two-part strategy. First, it invests in stocks based on an index, the Selective Vista Shares Berkshire Select Index.
Okay, and what's that index tracking?
So this index is designed to mirror the performance of the top 20 stocks by valuation from Berkshire Hathaway's publicly disclosed portfolio. Think BRK.B's holdings.
Based on their filings, right. So there's maybe a bit of a lag.
Exactly. It relies on those public 13F filings, so it's not real time. It replicates what Berkshire was holding as of the last filing.
Gotcha. And what kind of companies are we talking about in that top 20? Any familiar names?
Oh, yeah, definitely. As of mid-May 2025, you're looking at giants like Apple, American Express, Verisign, Kroger, Bank of America, big, well-known names.
Okay, so that's part one, investing in those Berkshire-like stocks. What's the other part of the strategy?
The second piece is that OMAH directly holds about 10% of its assets in Berkshire Hathaway Class B shares itself, so BRK.B.
Huh, interesting. So you get the top picks and a slice of Berkshire itself.
Right. It's exposure to the picks plus the mothership, so to speak.
And that ticker symbol, OMAH. Pretty obvious nod there, right?
Absolutely. OMAH, Omaha. Warren Buffett's hometown. It's definitely meant to signal that strong link to Berkshire and, the whole Buffett aura.
Okay, let's talk about the main hook, that income target. Seems really high. What are they actually aiming for?
Yeah, the target is high. They're aiming for 15% annual income. And importantly, it's distributed monthly.
Monthly, wow.
Yeah, so that breaks down to about 1.25% per month. Target-wide, you can see how that would appeal to income investors, right? Assuming they can consistently hit it.
Absolutely.
Yeah.
Have they been hitting it so far? It's early days, but
Yeah.
What do the payouts actually look like?
Well, as of the latest data point we saw, April 25th, 2025, the distribution was about 0.238630 per share.
And does that work out to the 15%?
If you annualize that based on the NAV at the time, yeah, it lines up pretty closely with that 15% target rate.
Okay, so that high income is key. How are they generating that? Dividends from Apple and Bank of America won't get you to 15%. The fact sheet mentions an actively managed options portfolio. Let's unpack that.
Right, this is crucial. A huge chunk of that income strategy relies on actively managing options. The main goal there is generating income from premiums, basically by selling options.
Selling options. Okay, can you simplify that? What does that mean in practice for this fund? What kind of options strategies?
The big one they mention is writing covered calls. So the fund holds shares of, say, Apple. They then sell a call option on those Apple shares.
Giving someone the right to buy the shares later at a set price.
Exactly. And for selling that right, the fund collects cash upfront, the option premium, that's income.
Okay, income up front, but what's the catch? There's usually a trade-off, right?
There is. The trade-off is potential upside. If that Apple stock price really takes off and goes way above the price set in the call option, the strike price, the fund might have to sell its shares at that lower strike price.
So they miss out on some of the gains.
Correct. They trade potential big gains for that upfront premium income. It's a classic covered call strategy dilemma. Balancing income now versus potential growth later.
And this isn't just set it and forget it. They're actively managing this.
Right. The managers are making decisions based on, their market outlook, volatility, trying to balance generating income with allowing some capital appreciation, and importantly, preserving the fund's asset value. It's dynamic.
This whole approach, using options for high income, it feels like we're seeing more of this in the ETF world lately.
We definitely are. OMAH fits right into that trend of target income ETFs. Investors are hungry for yield, especially when interest rates aren't super high, and these funds use options to try and deliver that.
Who's actually pulling the levers here? Who's the management team?
The investment advisor is ZGA Financial. And here's an interesting connection. ZGA also advises Defiance.
Oh, Defiance. They have similar high-yield ETFs like SPYT, right?
Exactly. And one of the fund managers listed for OMAH is also connected to YieldMax.
YieldMax, another big name in this space.
Right. So it seems the team behind OMAH has, let's say, a strong background, a pedigree in exactly this kind of high-yield, options-driven ETF strategy. Doesn't guarantee success, but they know the playbook.
That's really useful context.
Okay.
Okay, let's shift to the nuts and bolts. Key numbers, metrics in the fact sheet, that kind of thing. What should people know?
Okay, as of early May 2025, net assets were around $151 million. NAV per share, $19.24. Launched March 5th, pays monthly. The big one is the expense ratio, 0.95%.
Oof, yeah, 0.95%. That does jump out. That's pretty high compared to a lot of ETFs.
Yeah.
What's the impact for an investor?
It's definitely on the higher side. I mean, compare that to a basic S&P 500 index fund, which might be, what, 0.95%? So 0.95% means nearly a full percent comes off the top each year before you see any return.
So on $10,000, that's $95 a year in fees.
Right. And over time, that really compounds and eats into your net gains. It's a significant hurdle the fund has to overcome just to break even on the fee front, especially compared to cheaper options. You really have to believe that high yield is sustainable and worth the cost.
And how many holdings does it actually have? You mentioned the index tracks 20 stocks plus Berkshire.
Yeah, the fact sheet listed 94 holdings.
94. That seems like a lot more than 21. Is that the options?
That's most likely it, yeah. The underlying stocks are the core 21 from the index, but then you add potentially dozens of different option contracts, calls, maybe puts, at different strike prices and expiration dates. That bumps up the total number of positions.
Okay, let's look at those main equity holdings again. How are they weighted? What are the biggest positions?
As of May 12, 2025, Berkshire itself, BRK.B, was the biggest at nearly 10%. Then Apple around 7.5%, MX 7.44%, VeriSign 5.8%, Kroger 5.5%, Bank of America 5.1%, DaVita almost 5%, Citigroup 4.9%, Visa 4.7%, Coca-Cola 4.5%.
So heavily weighted towards those top names, as you'd expect.
Very much so. Concentrated in those well-known large caps favored by Berkshire.
And what about sector allocation? How is the money spread across the economy?
This is pretty striking. As of late April 2025, financials were over half the fund, 51.7%.
Wow, over 50% in financials.
Yeah, that's a huge concentration, something you definitely need to be aware of. If financials hit a rough patch, this fund will feel it more than a broader market fund.
What else?
After financials, it was consumer staples at 14%, tech also 14%, energy around 7%, healthcare just under 5%, communications about 4%, consumer discretionary 3.6%. But yeah, financials dominate.
Okay, we talked about the 15% target rate. What was the actual annualized rate based on the latest distribution?
Based on that April 25th payout, yeah, the annualized rate was running right around that 15% mark.
What about the 30-day SEC yield? That's supposed to be a standardized measure, right?
It is, yeah. It's a backward-looking calculation of income based on the last 30 days. But for OMAH, the data we saw listed it as not available, or just 7%.
Any idea why?
It could be because the fund is so new, or maybe because so much of its yield comes from options premiums, which can be lumpy and aren't captured the same way as dividends in that standard SEC yield calculation. It might just take time for that metric to populate accurately.
Makes sense. What about trading costs? If someone wants to buy or sell OMAH, what's the bid-ask spread like?
The median 30-day bid-ask spread was 0.16% as of early May.
So 0.16%, that's the typical gap between buying and selling price, something to factor in for trading costs.
Right, not super tight, not incredibly wide either for a newer specialized ETF. It indicates the liquidity.
And performance. Since it's so new, March 2025 launch, we don't really have any meaningful performance track record yet, do we?
No, not really. The data for 1 month, 3 months, year to date, it was all listed as not available. We just need more time to see how the strategy actually plays out in different market conditions.
Okay, so we've covered what OMAH is, the mechanics, the numbers. Let's pivot to why someone might consider this. What are the potential upsides?
Well, the number one draw, obviously, is that high monthly income potential. That 15% annual target paid out monthly. For anyone prioritizing cash flow, that's That's very appealing on the surface.
And the Berkshire connection is a big part of the appeal too, presumably.
Absolutely. It gives you a way to get exposure to that Buffett-Berkshire magic, or at least their top publicly known holdings, without buying all the stocks individually or trying to time the 13F filings yourself.
Sort of like a curated Berkshire portfolio ETF.
Kinda, yeah.
Mm.
Plus that direct 10% BRK.B holding. And, Berkshire stock itself has done quite well recently.
That's right. The source material mentioned BRK.B was up significantly in early 2025 when the S&P 500 was actually down.
Yeah, up 17.5% year to date through April 2025, while the S&P was negative. So having that as the underlying base for the fund, that recent strength could be seen as a positive.
Another potential plus is having professionals manage the options side, right? Covered calls aren't rocket science, but active management takes time and expertise.
Exactly. You're essentially outsourcing that option strategy to the VistaShares team. If you believe they have the skill to generate income effectively through options, that could be a benefit compared to trying it yourself.
And while it's concentrated, you do get exposure to a basket of stocks across different sectors, not just one or two.
Right. It provides diversification across 20 large and mid-cap companies spanning financials, tech, consumer staples, etc., based on Berkshire's choices. It's not total market diversification, but it's broader than just holding one stock.
Okay. Clear potential attractions. Every investment has risks. Let's flip the coin and talk about the potential downsides and concerns with OMAH.
Definitely need to look at this side. First, we have to circle back to that expense ratio, 0.95%.
Yeah, it's hard to ignore.
It really is. That fee drag is constant, and it means the fund has to work harder just to deliver a net return comparable to cheaper alternatives, assuming similar gross performance.
And then there's the big question mark around the distribution itself. That high yield. Where is it really coming from?
This is probably the most critical point. The data showed that a very large portion, like 95.8% of the most recent distribution, was classified as return of capital, ROC.
Return of capital. Okay, break that down. Is that bad? Why is it a concern?
It's not always bad. Sometimes it can be tax efficient. But fundamentally, return of capital means the fund isn't necessarily paying you from its earnings or profits. It's potentially just giving you your own initial investment back.
So that juicy 15% yield might not be actual investment gains?
Well, a large part of it might not be, no. If the fund's stocks and options strategies aren't generating enough actual income, the fund might dip into its asset base, your principal, to make that high distribution payment.
And the risk there is?
The risk is that it's not sustainable wealth creation. You're just getting your own money back, potentially taxed differently. And over time, this can erode the fund's net asset value, the NAV per share. There's a concern it could be sort of eating itself to maintain the payout.
That's a really crucial distinction. So the headline yield needs a closer look. What are the risks are tied to that heavy reliance on options?
Well, the income itself depends heavily on those options strategies working, and their success is tied to things like market volatility and the direction of the underlying stocks.
So if the market gets really calm or the stocks fall?
If volatility drops, the premiums they collect from selling options tend to shrink. If the underlying stocks fall significantly, that obviously hurts the NAV, and it can also impact the options income. And remember, the flip side of covered calls, they cap your upside. If those Berkshire stocks soar, OMAH won't capture all of that gain because of the calls it sold.
Trading upside for income.
Precisely. And then there's the concentration risk we mentioned.
Right, focused on Berkshire's top picks.
Yeah.
And that huge weighting in financials.
Exactly. Less diversified than a broad market index fund. Over 50% in financials is a big bet on one sector. If that sector stumbles, OMAH will likely feel it more acutely.
The newness of the fund itself is also a risk factor, isn't it?
Absolutely. Launched March 2025. We have no long-term track record. We don't know how this specific strategy run by this specific team will hold up through different market cycles, bull markets, bear markets, sideways chop. It's untested over time.
And the advisor, VistaShares, is also relatively new in the ETF space.
Yeah, that adds another layer. They might have experienced managers, as we discussed with the ZGA Defines Yield Max links, but VistaShares itself doesn't have a long history managing ETFs specifically.
What about the tracking lag? The fact that the index relies on older 13F data?
It's a factor. It means the fund might be buying or holding something that Berkshire has already sold, or missing out on something new Berkshire bought because of that reporting delay inherent in 13F filings. It won't perfectly mirror Berkshire's real-time portfolio.
And circling back to that return of capital, any other long-term worries there beyond just getting your own money back?
Yeah, if a fund consistently pays out more than it earns through income and capital gains and relies heavily on ROC, it can shrink the fund's asset base over time. A declining NAV isn't great, and it could eventually make it harder to sustain that high distribution rate down the road. It's definitely something you'd want to monitor closely if you invested.
Okay, one last potential risk factor, the man himself, Warren Buffett.
Right. The key person risk, essentially. Buffett is turning 95 in August 2025. He's a legend.
And Berkshire has a successor named Greg Abel.
They do, yes. Succession planning is in place. But still, Buffett's unique skill and influence have been immense for Berkshire. There's always some uncertainty about how any company performs after such an iconic long-term leader steps back. And since OMAH is so tied to Berkshire's portfolio, it's a relevant, if perhaps longer-term, consideration.
Okay, lots to think about there. So how does OMAH compare to other income options out there, like traditional dividend ETFs or even other options income funds?
Well, compared to traditional dividend ETFs like, say, SCHD, OMI's 15% target yield blows SCHD's typical 3-4% yield out of the water.
Right.
But SCHD has a tiny expense ratio, like 0.06%, compared to OMA's 0.95%. And SCHD's yield comes primarily from actual company dividends, generally seen as more sustainable, though lower. OMA brings higher potential yield, but also higher fees and the complexities and risks of options and return of capital.
What about comparing it to other options-based ETFs like GPI or QYLD?
Good comparison. JPI typically yields maybe 7-9%, uses options, but it's more diversified than OMID and has a lower expense ratio, around 0.35%. QYLD targets even higher yield, maybe 11-12%, focuses only on the NASDAQ 100 via covered calls, expense ratio 0.60%.
So OMAH is aiming for an even higher yield than QYLD, but with a different underlying portfolio, the Berkshire picks and the higher fee.
Essentially, yes. OMA carves out its niche by focusing on that Berkshire connection to generate its very high target yield. It sits in that high yield option space, but with a unique twist. Then you have extreme examples like MSTRY tied to crypto derivatives with astronomical yields, but also, extreme risk. OMA is high yield, but maybe not that extreme.
Okay, let's try and wrap this up. If you had to summarize the core strategy of OMA in a sentence or two.
Okay. OMAH tries to deliver a very high monthly income. It does this by holding stocks similar to Berkshire Hathaway's top picks, plus Berkshire stock itself, and then actively using option strategies on top of that to generate extra income from premiums.
Got it. And the key pros and cons for our listener to really mull over.
Pros. Definitely that high monthly income potential. The 15% target is the headline. And getting exposure to the Berkshire universe in an ETF wrapper, cons. That high 0.95% expense ratio is a big one. The heavy reliance on options, which have their own risks and cap upside. And crucially, the fact that a lot of the distribution so far has been a return of capital, which raises questions about sustainability and true yield. Plus, it's a new fund, new advisor, concentrated portfolio.
Right. So final thought for someone listening who's intrigued by OMA.
Look, OMAG is definitely interesting. It's a novel approach, especially if you like the Berkshire angle and you're hunting for high income. But, and this is a big but, because it's new, because of the complex option strategy, the high fees, and especially that return of capital element, you absolutely have to do your homework.
Don't just chase the yield number.
Exactly. Don't be blinded by the 15%. You need to understand how they're generating it, the risks involved, and if that aligns with your specific goals and your tolerance for risk. This deep dive hopefully gives you a really strong starting point for that deeper research or maybe a chat with your financial advisor. Is this truly adding value for you or just complexity and cost?